With China rapidly closing the gap in the AI race, the US and China are headed to a showdown. One country in the world stands to benefit from the turmoil ahead. So why is it not getting the respect it deserves from the stock market? What should you be doing with your money right now? "2025 will be remembered for Trump's trade war and the AI bubble. The first as a wrecking ball, the second as an airbag. The fact that the world stock market is on track for a double-digit gain for the third consecutive year suggests the airbag saved the day, at least for now. But the buy everything AI rally has passed one country by. The Indian stock market is up only 7% year to date, by far the worst performer among the major stock markets. This is despite the fact that India remains the fastest growing economy in the world. Trump's trade war has hammered manufacturers around the world, but not in India, where factories are still humming. The newly launched iPhone 17, which has received rave reviews, is made in India, marking the first time iPhones are manufactured outside China. So why is the Indian stock market not getting the love that it deserves? Foreign investors have been actually selling Indian stocks in 2025. The net sale of Indian stocks by foreigners over the past 12 months is not far from the record set in 2022. Foreign selling has been the key reason for the underperformance of the Indian stock market this year. The reasons cited for the selling includes slowing growth momentum, high valuation, and tariff risk. There's no denying that the Indian stock market is not cheap. With the trailing PE of Nifty 50 at 23, it is less expensive than the US and Japan, but more expensive than China, Europe, and the UK. But higher valuation comes with the promise of higher potential growth. India's 12-month trailing earnings per share growth trailed only that of Japan and the US, and was ahead of other major markets. Growth momentum did slow in the second half of 2024, as the fiscal priming ahead of the 2024 national elections waned. Growth picked up in the first half of this year. Indeed, the Indian economy grew 7.8% in the second quarter, supported by a reacceleration in gross fixed capital formation. However, there are concerns about slowing credit growth. I'm less concerned only because of the rapid deceleration of headline inflation of the past year. In real terms, credit growth has been picking up over the past few months. With core inflation running at 4.5%, the Reserve Bank of India has limited room to cut interest rates. But the steps taken by the RBI to allow banks to fund acquisitions and to ease capital rules earlier this month should help ease credit conditions. Meanwhile, there are signs that the GST reform introduced in September is already providing a boost to the manufacturing sector. The IMF just revised up its forecast of India's GDP growth to 6.6% for 2025, from 6.4%. But what about 2026? In a video in August, I argued that Trump had overplayed his hand with Modi and was risking pushing India into the arms of China. Reports this week that India and the US are closing in on a trade deal suggest a softening of the US approach. Media reports suggest that the US will slash the tariffs on India from 50% to 15%. In exchange, India will gradually reduce its purchase of Russian oil and increase the quota for its imports of genetically modified corn. In my view, it is no coincidence that this reported breakthrough is coming at the same time that tension between the US and China is escalating. I noted last week that China's relative bargaining power versus the US has improved since April. I argue that this made the latest showdown between Washington and Beijing much more dangerous than in April. An unintended consequence is that it has strengthened India's hand in its negotiation with Trump. Trump called Modi a great friend this week at a Diwali celebration in the Oval Office. He also changed his tune from "India will stop buying Russian oil" to "India is not going to buy much oil from Russia." To Modi's credit, he has played Trump like a chess master, sacrificing a pawn here, gaining a queen there, never losing sight of the endgame. As a result, India's strategic autonomy, its biggest asset in today's geopolitical realignment, is more secure than ever. In my mind, the Indian stock market deserves the high premium that it trades on. I suspect the Modi premium will go up in 2026. I bought some Nifty 50 futures earlier this week, partly as a hedge against my short position in Nasdaq 100. India and AI both offer structural growth outperformance. Except AI has become a bubble, and India is the worst performing major stock market this year. With the global stock market having racked up 3 consecutive years of double-digit return, I'm definitely not bullish about 2026. And if the global economy were to have a hiccup and the global stock market were to have a down year, the Indian stock market will not have a good year either. This is why I think of my long Nifty 50 versus short Nasdaq position as a relative value trade. There have been other years in which Indian equities have been the worst performing major stock market, but these years tended to be followed by outperformance. So this is my investment thesis. The worse the US-China rivalry becomes, especially in the realm of AI, the more the Indian stock market will outperform expensive US tech stocks. With China rapidly closing the gap in the AI race, I have little doubt that the rivalry will continue to intensify in 2026. Thank you for listening.